Hello, everyone. I hope you're all good.
Hello,
Good day, Professor.
Hi, Professor.
Hello. Concerning your grades, honestly speaking, I didn't have a time to go on it. I'm planning to finish this week, so I will just I'll let you know, and you can check the Moodle, and if you have any question, you can get in touch with me. So coming to your assignment, I'm very sorry, my phone wasn't off, I just offed it. So coming to your assignment, you're supposed to finish the collecting data, and you're supposed to arranging it and organizing before running the regression analysis. So would it be possible, just one by one, could you just share your screen and show me, except that Dana and Almat, because yesterday you showed me already in the WhatsApp, so that I can say that data is okay, you can start running the regression analysis if you collect it.
Профессор,
Yes.
можно у вас один момент спросить? Вот по нашему с Алматом работаем.
Yes, you can share the screen, please. You can share the screen.
Yes.
Let me just stop my sharing the screen.
Can you see it?
Wait a second. Yes, I can see it.
For example, in let me just open. Here, for example, for LBBW Bank, I found only for 2019 the credit risk, because in annual report it was written like non-performing loan ratios. But for other years, for example, from 2009 and to 2018, there is nothing about non-performing loans. And I just wanted to ask you, to find the credit risk, should we, for example, here is the annual report for 2016, and here I just found it. Here, should we just sum up these two type of loans and allowances for losses divided to this sum?
Yes, 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 that's true.
But I have very, very low
Results. Yeah, there's nothing wrong with this. Nothing wrong with this. And it will be negative, as you can see.
Yes, yes, negative for each years. Yes. It's like 0.00006, like this.
I have the same results, very, very low. That's okay.
It's okay, yes? Okay. Yes, I just wanted to ask this. Thank
Anna,
you.
can you show me again
Professor.
what is the number of the years you are using? How many years?
10 years from 2010 to 2019.
19. The 20 was not available, I guess, huh?
Yes, yes.
Yeah,
Nice
it's
one.
still
Not find.
processing.
And for this dummy, wait, what I don't like it here, you put 1 for 2019 and 2018. Why?
Yes.
So what you're supposed to do in here, for this, why this time dummy was given here like this?
Can I say, Professor?
Yes, please, Rahmat.
Actually, yeah, I just accidentally put there these numbers. Remember, you said that we should put 1 for 2008 and 2009.
2007, yes, 2009, the
Yeah,
global financial
2007,
crisis
yes.
period.
But as we didn't cover that years,
So you don't
there
have it. Then you don't have to use the time dummy here.
we don't have to use it.
Yeah, because, or do you know that specifically something happened very, very important in Germany in a specific year? Find it and let me know. And then we can put, like, let's say in 2013 and 14, let's say something happened, some political crisis. So we put 1 as for this years and 0 for other years. So this will help us to understand whether this change or this event had some effect on the credit risk.
So, Professor, if we won't find any event, so then we don't use anything, yes?
Search
Instead
it,
of dummy.
search.
But we'll try, yeah.
I'm sure that something happened during this 10 year, very important, like the political one. It could be economical, it could be political one. Maybe tax changes or something else. Just search in the Google, okay? Like crisis in Germany for the last 10 years or something like this, and just go with it. There is something. So we'll be in touch. I think I would like to ask the Al-Nur to present their data collection.
I'm sorry, Professor, I have a question here.
Yes.
Dana, could you share screen
Yes,
one more time? So, Professor, if I got you correct, so our 1 minute, our liquidity ratio, not liquidity, but the non-performing loans ratio should be negative, yes? Like minus, for example, here.
No. No, it's not here. Because in the annual report, it could be shown as a negative number due to the reason that they are subtracting directly from the loans to show that subtraction.
Now I got it.
But show it in an
confused.
absolute term. Show it in an absolute term.
Okay, thank you.
Thank you.
Okay.
All right, now it's my turn, right?
Yes, please, Al-Nur, share.
Okay, all right, so I'm Sean. Can
You're
you see
alone?
my screen? No, I'm with Dinara Saidin.
Okay.
So, all right, Professor, to be honest, our work is in work in progress. I mean, we gathered data
Okay.
and there's just
So
some
what I can see here, Al-Nur, I will just directly just give you kind of small warning about the data. It's very important. In some you used it with the decimal 0.0 something, your credit risk. I cannot see the screen. And some using the percentages. Please convert them into one standard. Either use them all percentage or decimal.
Okay. Got it. Okay.
There's nothing wrong with the GDP and the political index. That's okay. But this bank-specific variables or firm-specific variables you are using.
Yeah. Can I just have one question?
Yes, sure.
So speaking of the liquidity ratio, I got, it was like almost more than 90%. So as you can see for all of the banks, I just want to make sure that I have the right understanding of how to calculate it. So as you can see, I took a lot of items from the balance sheet. I just want to make sure that they are all correct. For example,
So which items did you take it? You took just current assets?
oh, I took, so as you can see, since it's a bank, I took cash, then due from banks, receivables, and up to the financial investments. So all
Oh,
this.
no.
Right?
Yeah,
There's-
no, it's wrong. It's wrong. You had to take up to the trading, not including.
Trading, right?
Yeah, trading portfolio. So don't include the trading. So what you need to include the first three variables: cash due from banks and the receivable from securities financing transactions. So these three variables could be considered as a current assets.
Okay. Now I
But
got it.
those, which is trading, positive replacement values, and other financial assets at fair value, they're all like more than 1 year. So it's better for you to consider only these three things. Definitely, then that's why you might have the liquidity high. And what you're measuring is not the liquidity; it's just showing you the management of the assets.
Yeah. Okay.
Okay.
Now I got
Just work out the liquidity again.
it. Right. That's
Okay.
it.
Thank you. So we are done with you. Okay. Next, I have Alnur Dinara finished. Dan Almat. What about Anwar? Is here?
Yes, Professor, I'm here.
Please, did you collect anything?
Yes, I collected, but I'm sitting from my phone and I cannot show my Excel file.
Okay, send it to me then later to my WhatsApp. Okay, I want to check.
Okay.
And we have Aidana, UK for banking. Aidana, she's not here. And I have Lee, US for utility.
Yes, I'm here.
Okay, would it be possible for you to share the screen?
Yeah, can you see it?
Wait a second. Yes, I can see it. Okay, net interest margin. So what did you use for the net interest margin? Do they have the net interest margin?
Oh, I'm using.
I think they don't have the net interest margin. They have another profitability measurement.
They have net interest income, and I just divide.
They have it. They have it. They have it. Very interesting. They have that. What you did is correct. I thought they don't have from their annual report, but they have it.
Correct data from Yahoo Finance and their annual report.
Okay, got it. And your number of the years you considered for the last 10 years?
Yeah, not last 10 years from 10 to 19.
Okay, which country? US.
Oh, USA, yeah.
Yeah, the 2020 is not available, huh?
Yeah, it's not available.
Okay, all the variables are all in percentages. Great. Non-performing loans are here, liquidity is here. Great. Okay. And in your case for the US, definitely there's something happened. The presidential, the Trump, when he was a president, use this thing, okay?
Okay.
Make the years that the Trump was a president, make it 1, and for the rest, make it 0 for the dummy variable. Did you get it? Let's say for the last 5 years or 4 years, 2019, 18, 17, 16, check the number of the years correctly and put it as 1 for those years, and for other years, put it 0. Okay, you can stop sharing. Let me just go another. Evgenia?
Yes, Professor, but I showed you maybe 2 classes before.
Yeah, remember. So you don't have any questions, Evgenia?
No.
Okay, great then. Would you finished? Utility finished. Saken?
Yes, Professor.
Would it be possible for you to share the screen if you have
Yes,
collected?
of course. I had gathered only 3 banks, but for the last 25 years. I will.
Great, great.
I will collect the other banks during this week. I just didn't.
You're working with the Australia, but
Yes,
what is the latest date?
For Australia,
Yeah.
latest 2020. I have 2020.
Oh, great, great. That's really great. That's what really I was looking for it. That's very, really, it's awesome. Then for dummy variables, we can create two dummy variables, one for the global financial crisis and one for the pandemic.
Okay.
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 So dummy variable 2, dummy variable 1, global financial crisis, which is 2007, 2009, 2008, these 3 years, 7, 8, 9, put it 1, and for rest zeros, and dummy 2, put it 0 for all except 1 year, which is 2020.
Okay.
Okay, you will do it at home then.
Thank you.
Thanks. And the data is correct. I think, yeah, perfect.
Thank you.
Okay. Temirlan? Is he here, Temirlan? No, he is not. Okay, we skipped it. And we have Jean.
So, Professor, we are making work with Anwar together.
Ah, you're making with Anwar.
Yeah.
You combined.
Yeah.
I have to change it then.
So, is it okay if we will send
Yeah,
you?
it's okay. I don't mind. But Jean and Anwar, you're together, but you will be working on the automobile sector, yes?
No. Pharmaceutical sector, Professor.
Pharmacy. Okay, I'm taking a note.
Professor, have you called me? Just I have trouble with connection.
Yeah, Temirlan, I was calling you, but just a second.
Okay.
Just a second. Let me just see the Anwar's issue. Jean, so you're working with the Anwar. Did you have a chance to collect anything? If yes, please, can you share it with us?
Yes, but I have the same problem as Anwar. Now I'm at work and sitting from the phone.
I see. So I'm expecting from you guys to send it to me. And your
Okay.
country was US, yes?
Yes.
Okay, great. Now we can come to the Temirlan. Temirlan, you're working with IT fields, yes?
Yes, I'm working with the IT field and I have the same problem. I'm outside and I don't have
then so from 3 of
I'll
you,
send
I'm
you.
expecting.
But the only one thing that I didn't found is the dummy. I don't know how.
Dummy, you don't have to find it. We created ourselves.
Okay.
We created ourselves. When I see your data, I will tell you what to do with the dummy.
Okay. Thank you, Professor. And I have a question about the allowances for doubtful. There are only two things that I have troubles.
I didn't get your question. Can you repeat again the voice?
Professor, I have troubles with the allowances for doubtful.
Okay.
Yeah. Just do I need just to divide allowances for the accounts receivable?
No. Yeah. Surely. You can divide it by the account receivable to get the pure the credit risk. I mean, credit risk of not collecting the receivables.
Okay. But if this information is not showing in the statements where it is showed, it must be showed.
It should be there. It should be allowances separately and account receivable separately. It should be
separately.
Yeah.
Okay.
But should be.
Usually allowances is in the accounts receivable. Like allowances, less allowances for this number and this number. But starting from the 2020,
not the one who already did not perform well, but I want you, which is like probability that they will not be collected.
Okay.
Make some allowance without any subtraction. Just get the numbers and make division.
Okay, got it. Thank you, Professor. And that's all, and the other data is collected already from 2020 up to 2010.
Okay, great. once, let me just share the screen with you. I will update it. Okay, now we are going to start a new chapter, which is interest rate risk. Okay. So when the interest rate changes, the change affects the bank's interest income on loans and the securities, and the interest cost on the deposit on other banks' borrowing. So changing in interest rates also change the market value of the bank's assets and the liabilities, thereby changing the bank's net equity, which is the value of the owner's investment in the bank. So changing the interest rate will affect both the bank's balance sheet and its statement of income. Honestly speaking, the change of the interest rate, it will affect the whole sector, because the banks are the main drivers of the economical growth in the whole sector, because all the manufacturer companies in different types of fields, they really depend on the banking. If the banks stop lending the money, if the banks stop distribution of the loans with a low interest rate, that really will affect the manufacturer companies, because they will not be able to borrow anything, at least to pay their debts, to pay their expenses for short term. And as you're aware of that, all the firms, small enterprises and medium enterprises, they borrow money to finance their salaries, their wages, to pay their utility expenses, in order not to be late on the payment date. So if the bank increases the cost of borrowing, that may affect of term. That might affect actually not only the banking sector but the real sector as well. So the loanable funds theory is the interest rate determination views level of the interest rate in the financial markets as resulting from the factors that affect the supply and demand for the loanable funds. So as we know that there is a demand and supply for goods and services, and there is equilibrium. From the economy, we know it. This is the supply, this is the demand, and this is the equilibrium. Okay. And this is the best point. This is the equilibrium point. This is the point where both sellers and the buyers are satisfied. The same thing is existing for loanable funds. Those who supply the loanable funds and those who demand for the loanable funds. Who supplies the loanable funds? Who supplies the money are the banks, are the financial institutions. And those who demand, they are the borrowers, they are the household. Okay. And in here we may have as well the shortages and surpluses of the loanable funds. And this is the interest rate. And this is the quantity of loanable funds. And this is the equilibrium quantity. If loanable funds is supplied, let me just draw it very good, in a good way. The price of the loanable funds is the interest rate. This is the quantity. This is supply. This is demand. This is the equilibrium, okay? One. If interest rate increases, let's say, if interest rate increases to I2, which means the cost of the loanable funds will increase. That will really make more money to the financial institution. That creates a really huge amount of the money to the financial institution. However, the borrowers, they are not ready to borrow the same amount of the loan that they used to borrow before. at this rate. So there is a kind of a surplus of the loanable funds. So there's a lot of money available in the market. So they decide, no, we're not going to borrow. At this price, the quantity of demand is of the loanable funds will reduce to here, to Q1, and supply of the loanable funds at I2 will go up at here. So they will be high. So the suppliers of the loanable funds, they say, at this rate, we already supply a lot of money because we want to earn more money. More money lent, more money earned on this. However, the demand for the for loans are not really satisfied with this interest rate. So this surplus actually put a pressure and put it down to equilibrium back. And if the interest rate falls, here, let's say, if interest rate falls, to let's say I3, then we can see that this is a shortage of loanable funds. At lower rates, the banks are actually less willing to lend anything. They say, why we should lend it at this low rate? Because if we lend it at this low rate, we're not going to earn anything. So we will lend at Q1. However, the demand for the borrowers, the demand for the loanable funds, they say, this is a really good rate. We can even buy or we can borrow more money that we could use to borrow previously, because previously we used to pay higher rate. It was a higher cost. Now the cost is reduced. Now we can borrow more money on it. So this is how it works. Create the surplus and shortages. The shortages of the loanable funds will create a pressure and it will push up to its equilibrium, where the both demand and supply are satisfied. This is about the loanable funds theory. So what is the monetary policy? We have actually on one hand the monetary policy, on the other hand we have a fiscal policy. Basically, the monetary policy is all about the money that the central banks work with. So monetary policy is the demand side of the economic policy that refers to actions which is undertaken by central bank to control the money supply, the quantity of the money in the economy. The idea to do that, why the central banks would like to control the money supply, is basically to achieve the macroeconomic goals that promotes a sustainable economic growth in the country. So the monetary policy has got different instruments or different tools to control the money supply. I mean the loanable funds. As we refer to the graph that I illustrated in a previous slide, the loanable funds is equal to the money supply. So the same here. Supply, demand. Let's say 2%, or let's make it Kazakhstan, 12%, and 1 billion. So at 12%, the banks are willing to supply the money to the economy, 1 billion. And there's a demand for the same amount, like everybody's satisfied in here. But if the rate raises to, let's say, 20%, actually the banks will be more happy because now they will earn more money. And they say in this case, we are ready to supply 2 billions because it will bring us more money. So we'll be more happy on it. So there is a shortage. So there is a surplus of the loanable funds, of the money supply. There's a lot of money. So interest rate increases. But when the interest rate falls, let's say 8%, the banks and the financial institutions, they will not be happy. They say at this amount of the money, we are not ready to buy something. So we'll just supply half billion of the money at this rate. Sorry, it's somewhere here. Here. Even like, let's say 2%, like 20% of the 1 billion they will supply. But the demand says we will buy more even in this. Okay, my diagram is not really perfect in here, but anyway, just I want to illustrate that there's a shortage and the surplus of the money supply. And so we have to, the banks or central banks, they should be very careful when they pump up the economy with the money, not to create the surplus and not create the shortage. So one thing I would like to ask you, if there is a surplus of the money, there's a lot of money in the economy, will be there inflation?
Yes.
Yes.
So if the money supply increases, that will actually cause the inflation. So inflation up. And of course, the interest rate goes up. The loanable interest rate, as the money value increases, I mean, it loses, or the vice versa happens. So basically, there are three instruments used in monetary policy by the central bank. Fed monetary policy, it's a Federal Reserve System. In all countries, in every country, there is a central bank that uses monetary policy with the three different instruments. One is the open market operation, the other one is the discount rate, and the third one is reserve requirement. So these three tools are used to control the money supply. Open market operation, or abbreviated as OMO, is the buying and selling the government or Treasury Department securities in the open market. Discount rate is the setting the risk-free overnight interest rate, like the rate which is between the banks, among the banks, when they lend to each other. If discount rate is very low, that means the banks were willing to borrow more money from the central bank. If the discount rate is very high, the cost increases and the bank are less willing to borrow anything. Or reserve requirements, like every bank should keep some of the money that they receive as a loan and they cannot lend it directly. So we know that the banks or the financial institution, they earn like from deposit to lending. So they're kind of middlemen, okay? They receive the deposit and they lend the money. Let's say they pay the deposit of 5% and they lend it for 10%. If receiving money, deposit, or the borrowing money is less than 5%, it goes down, then as a discount rate, that will increase the quantity of borrowing and they will lend more money. So there will be more money in the economy. However, if the reserve requirements, which means that if the bank receives some money, let's say 100 million they receive as a loan from central bank, let's say discount rate is 10%, that means that they have to keep in the bank 10% of the received amount. Or if the reserve requirements increases, that actually reduces the quantity of money circulating in the economy. So as in here, you can see it, demand and supply of the loanable funds, as we illustrated, like surplus and shortages. This is more accurate and more beautiful drawing than mine. And here we can see that interest rate, the relationship between the money supply. As money supply, there's a positive relationship between interest rate and the money supply. And demand for money and interest rate, they have got actually inverse relationship. So once the interest rate goes up, the quantity demanded for loanable funds falls down, and in opposite. So increasing money supply, or we increase the supply of the loanable funds, which is shift to the right. as we can see here, that actually reduced the interest rate. That actually reduced the interest rate. And the quantity will increase. The quantity will increase. But we assume ceteris and paribus, that the demand curve does not shift left and right. So it's just fixed. Everything is kept constant. Only the supply curve shifts to the right, like more banks into the economy. Or increasing the demand for the loanable funds. If the firms and the companies, they started to demand more money and the number of the firms in the market increased, that will shift demand to the right. As you can see, the quantity for loanable funds demanded will increase and the interest rate will increase. And the example of the monetary policy implementation, so most widely recognized successful implementation monetary policy is in the US, which occurred in 1982 during the anti-inflationary recession caused by the Federal Reserve under the guidance of the Paul Volcker. And more recent example of the expansionary monetary policy was seen in the US in the late 2000s during the Great Recession as well. So as housing prices began to drop and the economy slowed, so the Fed decides to cut its discount rate from 5.25% to close zero in 2007 and by the end of the 2008. So with the economy still, with this economy which is still weak, it's embarked on purchases of the government securities. So as we can see in here, the US, the monetary policy was two instruments were used. Like one is open market operation, the other one is a discount rate. One is they cut the interest rate to zero almost, and the other one they just purchase the government securities so from the market. So when you buy the securities from the market, you pump up the economy with money. Or when you sell the government securities to the economy, you're reducing the money supply. You're getting the money from the economy. This is what it means. So as an example, in 2007, and this action actually by the central bank of the US is replicated by other countries as well, like Kazakhstan, the Central Asian countries, CIS countries, and Turkey. They did the same thing. They cut the interest and they pumped up the economy with money. Hello, I think you lost me. My internet connection gone.
Yes.
Okay.
Yeah, now we can hear.
Now, the periods of, there's some empirical evidence on the Fed's influence. It says that the period of expansive monetary policy, which is associated with the strong stock performance, and where the period of the restrictive monetary policy is generally coincide with a weak stock performance. And small cap companies are more sensitive to the Fed's monetary policy decisions rather than the large cap companies. And there are many evidence that could be driven out. However, these are the most popular one. So coming to the interest rate risk and the net worth of the bank, all the financial institutions are exposed to the risk due to the maturity mismatches that arises between the asset and liability. Interest rate changes can have some severe adverse impact on the net worth. So there's some topics in here that for these chapters, it might be very familiar to you because you have already taken some courses and it could be overlapping chapters, okay? Don't be surprised. So levels and the movements of the interest rate. So through the open market operation, the central banks, basically the Fed, they influence the money supply, the inflation, and the interest rate. Okay. So in particular, we concentrate on three models of measuring the asset and liability gap, which shows the exposure of the financial institution. The first one is the repricing model or funding gap. The second is the maturity model, and the third is the duration model. Repricing model concentrates on the impact of the interest rate changes on the financial institution's net interest income, which is the difference between FI's interest income and interest expense. And because of its simplicity, most small financial institutions use this model to assess their interest rate risk exposure. So the major weakness of the repricing model or pitfall, it uses the book value instead of the market value. And we know there is a big gap between the book value and the market value of the balance sheet, not only in the financial institutions, but in all other types of businesses. The maturity bracket, which is the commercial banks must report the repricing gaps for assets and liabilities with the certain maturities, like 1 day, more than 1 day, more than 3 months, more than 6 months, or more than a year to 5 years, or more than 5 years. So this maturity bracket, we're going to use it to estimate by employing these three models, like the pricing model, maturity model, and the duration model. Under repricing gap approach, the bank reports the gaps in each maturity bracket by calculating the rate sensitivity asset or rate sensitive liability. But rate sensitivity here means that asset or liability is repriced at its near current market interest rate within a certain time horizon, which is assigned at the beginning when the loan was issued. Example given here, the asset and liability and the gap between is -10, and it shows there is a gap. If it's 3 months, as you can see here, the gap is almost the same, but the cumulative gap is more. And if it's 6 months or more, the cumulative gap, the gap is increasing and even gets closer to 0. And up to some point, and again, it starts going down. So at the end of the day, the cumulative gap of all years or 5 years, it becomes 0 in here for this example. So applying the repricing model, the idea of the repricing model, again, we would like to see what will be the impact of the interest rate changes on the financial institutions. So in here, the change in the net interest income, it shows that rate sensitive asset minus rate sensitive liabilities multiplied by rate, or in other words, a gap of certain company is multiplied by change interest rate or rate of certain company. Gap is the dollar size of the size gap between this rate sensitive asset and rate sensitive liabilities. If we can use the previous example, we can calculate the gap of the, let's say, for 1 day. Let me make it bigger. Okay. So from the previous example, we get the 1 day gap. So between the $20 and $30 difference. So we just subtract from rate sensitive assets, the rate sensitive liability. So there is a gap of minus 10 million. So which means a positive increase in the interest rate. If the interest rate increases, that will actually reduce the net interest income, because your rate sensitive liabilities are more than rate sensitive assets. So you should be, actually the financial institution, specifically this institution, is exposed to increase of the interest rate. But if the interest rate falls down, they will actually gain here some income, because the rate sensitive liability will be higher than the rate sensitive assets. So applying the repricing model, we can consider cumulative 1-year gap. Okay. Let's see what will happen as coming back to here. It was 1 year cumulative gap, which is 15 million. And change of interest rate, again, we can see it's a negative number. It's a negative number. So exposure of the financial institution is increasing the interest rate rather than decreasing. So reduction in the interest rate will put the banks in a good position. So as a financial manager, you should be careful if your investment company, as we have seen it in the even energy sector, utility sector, they're really dealing with the loans like net interest income. So it means that the money they generate from the utility sector, they invest in the financial market. Okay, in the US, they invest in the financial market. So if they invest in the financial market, and we know that the financial market is directly related to the interest rate changes and it's exposed to the interest rate changes. So basically, if you are investing in the financial market, that means you're exposed to the changes in interest rate as well. So you should be really take care of interest rate changes, and you're trying to predict in what way the interest rate will go. And that's what the reason was why I asked you to find how to determine the non-performing loans or determine the financial performance of the banks, the interest rate expense, credit risk, or the interest rate risk, the factor that affects. In order to, at the end of the day, we can predict in what factors affect the interest rate and what factors affect your performance, so that in order to improve it, we will be able to get really good position in the future. So examples from hypothetical balance sheet. So short-term consumer loans, if they reprice at the end of the year, they would just make 1 year cutoff, and 3 months T-bills reprice at maturity every 3 months. 6 months T-notes are repriced on maturity every 6 months, and 30-year floating rates mortgages are repriced at every 9 months. So there are some financial assets which are not repriced. So you should be very careful about it. Rate sensitive liabilities are the same, backdated and repriced in the same manner as rate sensitive assets. So demand deposit and the passbook saving accounts warrant and special mention. So generally consider the rate sensitive asset as an act call for deposits. But there are some arguments for their inclusion as a rate sensitive liabilities. So example we are given here. Short-term consumer loans, long-term consumer loans, 3 months T-bills, 6 months treasury notes, 10-year fixed rate mortgages, and 30-year mortgages. It's asset and liability side, equity, capital fixed, demand deposits, passbook saving, 3 months CDs, and so on, as we can see it. This is an example of repricing, like equity capital is not being repriced, so we do not consider demand deposit is not being repriced. So what could be repriced within the year is 3 months CDs, 3 months bankers acceptance, and 6 months commercial papers. Or 1 year time deposits could be repriced, but not the 2 year time deposits. So it may be useful to express the cumulative gap ratio as a form of cumulative gap over the asset. The first reason is it provides the direction of the exposure, and second, it shows the scale of the exposure. So as we can see, we have a positive number here, so it's positively related to the interest rate changes. So if the interest rate goes up, that means the net interest income will go up. And how much in terms of the scale it will be changed if the interest rate changes. So example, if the rate increased by 2% for rate sensitive asset and rate sensitive liability, expected annual change in net interest income will be the following: 150,000. Because cumulative gap change was 15 million from the previous case. So with the positive gap rates and net interest income, they move in the same direction, in the same way. So And of course, there is a change that takes a proportional manner. However, if here's the assumption that interest rate changes in a fixed manner, okay, with the respect to the sensitive asset and with the respect to sensitive liability. So they're changing in the same proportion. But if there's unequal change rates, okay, if it's changing unequally, if the change rate on sensitive assets are not equal, then the spread changes in this case will be here. And it will really show a different story in here. So we are given here another example, like if rate sensitive assets increase by 1.2% and rate sensitive liability rises by 1%, then the change in the net interest income, having this change in revenue, interest revenue and change interest expense will give us actually change in net interest income. So what we have here actually on one hand that changes in rate sensitive asset is higher than changes in rate sensitive liability. That's why we get a positive change in here. And we're assuming that the gap is 155. And financial institution can actually restructure the assets and liabilities on or off balance sheets to get the benefits from the projected interest rate changes. So if you're expecting that the interest rate change will go up, then you should restructure in a way you get the positive gap, make your assets more than liability. If you expect that interest rate is going down, then make restructuring of your asset and liability negatively, like keeping the negative gap. So that will really give you the benefit of earning some money on the reduction of the interest rate. So positive gap example is given here, like rate sensitive asset is 400 and rate sensitive liability 500. And we can see there's a gap between 500 and 400, which is 100 million of gap. So this bank has the positive of gap 100 million. So if the interest rate increases, the banks will make some money on it. If interest rate falls, the bank will incur some losses in here. So the bank with a positive gap will lose net interest income if interest rate falls, or the vice versa. So restructuring the gap, there is an example for Harley-Swile Saving Financial Corporation at the end of the 2008. So there's some examples given how they restructured, and commercial banks, they could really earn the money if they restructured on time their financial assets, and they could really just scrap the largest market share at that time. Zero interest sensitive gap, this is another strategy, okay? Instead of just restructuring your balance sheet, you're trying to keep the strategy of zero interest sensitive gap, which means if the interest sensitive asset and liability of the banks are equal. So these banks relatively is actually insulated from the interest rate risk changes. So it's kind of reducing the exposure of the interest rate. So you're putting yourself into the risk averse or risk neutral. So you don't like to get money. Okay, you're not for the purpose to earn really high profit, but you're trying to keep yourself more stable. So basically the bank's gap ratio will be here 0. And here's some strategies are used in the gap management. Expected change in the interest rate risk. And if the interest market rate is increasing, then try to get the positive. If you have a positive gap, then they increase the asset and increase the decrease the liabilities. Or if you're expecting the falling of the interest rates and keeping the negative, having the negative gap, then you have to actually restructure in a way that you will reduce the assets and increase the liabilities in order to get a benefit from it. These are the strategies that we're using it. And there's some weaknesses that we have actually in here. First weakness, it ignores the market value effects of the interest rate changes. It over aggregative, so distribution of the asset liability within the individual brackets is not considered, which means that one asset, let's say the loans, example of the asset, but they are given as a general loans, but we know that the loans are really distributed among themselves as well. And there's some mismatches within the brackets can be substantial. So first, the third one, it ignores the effect of the runoffs. So the bank continuously originates and retires the consumer and the mortgage loans, and its runoffs may be rate sensitive as well. And the most important one, off-balance sheet items are not included in the repricing model. So hedging effects of the off-balance sheet items not captured. Example, future options, loan commitments are the one of the off-balance sheet items that really affects the liquidity and the gap of the certain financial institution company. Because if you don't consider, honestly speaking, it might seem very good and positive, but at the end of the day, you realize that your off-balance sheet items are higher than your on-balance sheet items. So that really might have a really huge effect on it. So you should be very careful. And this is all for this chapter. And next class, we're going to go over the examples, the way we can apply and try to see how can we get some practical and theoretical support on estimating certain interest rate exposures, interest rate changes. If you have any questions, I will be happy to answer. If not, I will take the attendance. If you have questions, please feel free to ask.
Professor, which chapter is that?
It is just here, interest rate risk 1, lecture 4.
I mean the book.
In the book, it's chapter 8.
Chapter 8.
Book is here.
This one, right?
Yeah, this one. Chapter 8.
Good. Thank you.
Financial institution management book. So at the end of the book, there's a question that we need to solve. We will solve it.
Got it.
Okay. Aidana, she was not here. Lee, he was here. Evgenia,
I'm here.
Almat, Arina,
Here.
Saken,
I'm here.
Anwar is here. Dinara,
Here.
Dana, here. Temirlan,
I'm here, Professor.
Okay. I lost you.
I'm
Jean?
here, Professor. Jean is here.
Okay, great. Okay, guys, I would like to let you go earlier. And by the way, tomorrow and on Saturday as well, or sorry, the Wednesday, let me just open the site for you. If you have a free time, there will be a kind of small seminar, okay? There will be a kind of small seminar from Tengri Partners, okay? You can attend it. It's supposed to be today as well. Unfortunately, today he had some urgent meeting with the board of directors. He will not be able to come today, but he will come tomorrow and the day after tomorrow. So if you want, you can participate as well. The Zoom link is the same. Okay. Head of Financial Advisor of Tengri Partners, like capital budgeting in general, in practice. And he will be delivering after the study break when we have it next week. After that study break, he is going to share a real case from the investment bank. Not today, but after study break. Like during the 1 week, he will show how they estimate weighted average cost of capital and for what reasons they do this estimation. He will just illustrate like step by step. If you will be free, you can attend it. You can get the benefit on it.
Thank you for sharing that.
Thank you, Professor.
Thank you, Professor. Goodbye.
Okay. Goodbye.
Thank you.
Take care then.
Goodbye.
Thank you so much. I
Goodbye.
see you on
Wednesday.
Wednesday.